It's Monday, and that time to get you a global view. India consumes too much and invests too little. That's the word coming in from Viktor Shvets of Macquarie. He also says that emerging markets are likely to face three key challenges going forward. I had a chance to interact with him and begin by asking him about the converging policies of global central banks. Listen in.
That's very true. Now the question is whether they know what they're doing. And that's really the key that investors need to focus on. Because at the end of the day, what central banks do, particularly major central banks, they're managing a massive global finance pie, which is anywhere from 5 to potentially up to 10 times larger than the underlying economies itself. Now, that sort of a cloud has a different dynamics, different rules to what the underlying economies have. And so the question is, how far do they push? How far do they try to tighten liquidity? How far do they try to tighten the cost of capital? Because 4%, if US was an isolated economy, 4% is probably the right interest rate for the US. But what is the right interest rate for US? Is it the right interest rate for the rest of the world? And the answer largely is no. Similarly, BOJ is reluctantly participating in this process. ECB cannot make up its mind whether it should be hawkish or whether it should be dovish. On the other hand, what you're seeing is increasing volatility in the currency markets. What you're seeing is rolling over gradually of direct foreign investments occurring, particularly in emerging markets. So if you think of India, for example, or you can think of the Philippines or many other emerging markets, they're starting to get back a lot of sort of stagflationary pressures, where inflation rates are starting to accelerate faster than the underlying economic growth rates. So they have their own problem. How much do you try to tighten in an environment where global liquidity is also tightening and global cost of capital is tightening? So it's a multifaceted game that central banks are trying to do, and one just hope that they actually know what they're doing.
If I can just contest that slightly, I mean, at least looking at the Indian context, because I heard you mention India in the list of countries where you mentioned that there might be a return to stagflation of sorts. If anything, while inflation has crept up a bit, it is not really dramatically off from what the Central Bank of India wants, or what's traditionally been a reasonable level of 4% odd. And growth in India seems to be on the up. This current earnings season and the commentary from corporate India also seems to suggest that growth is on its way up. Why would you believe that India seems to be around countries which might be getting impacted by stagflation?
Well, what's your twin deficits right now? You're running twin deficits of about 8-9%. They crept up quite a lot. Actually, over the last 18 months. So if you think of India, your wholesale prices are now hitting much higher levels. You're looking at more like 6%, and potentially it could get worse as we go forward. So in other words, what you're doing, in India has not done sufficient supply side reform to ensure that GDP growth rates can accelerate without causing either significant inflationary outcomes or causing potentially destabilizing current account and fiscal deficits. That's my point. And the key there clearly is structural reform. The more one does structural reform, the more one invests in either core or human infrastructure, the more flexible economies become. And therefore, neither inflationary pressure nor current account pressures will be as significant. So that was my essence, that you're growing too fast. For your own good. And so when you start dialing it down and or starting to restrict the economy, and the global economy is also likely to be more restrictive, both in terms of the flows and potentially cost of capital, how do you find that sort of right balance between the two?
Would you reckon then, Victor, that foreign investors by and large could stay away going ahead as well? I mean, thus far, flows have been mixed, but looking at dollar-denominated returns for any global investor, in India, they've been next to negligible, despite the fact that the index is up about 7% YTD. Do you think that coupled with the fact that, or coupled with the belief that dollar may not weaken if it doesn't strengthen too much, and the problems that you spoke about, would you believe that foreign investors would by and large give India a miss for the rest of the calendar as well?
Well, if I think of MSCI India against, call it Asia, Japan, India performance was not that bad. I mean, year to date, if you invested in the Philippines or Indonesia, you would have lost between 15 to 20% of your money. In India, actually, performance was not that bad. So from that perspective, people who actually put the money into India have done better than they would have done putting into many other locations. Now, going forward, it's at least for the next 2 to 3 or 4 months, I think US dollar probably will stabilize for a while. If trade tensions get perhaps a little bit less pronounced than what they were, in India you have gone from being overbought by foreign investors to being slightly oversold. There is actually quite a lot of very high quality domestic corporates, something that many markets don't have, but India does have. So to my mind, in the shorter term, I think India will continue to do fine against most other benchmarks. But if you're going beyond the next 3 or 4 months, the emerging market universe as a whole is confronting 3 major difficulties. Number 1, global liquidity is contracting. Number 2, volatility in bond market and currency markets are increasing. And number 3 is China. We can debate how much are we on the wrong side of China, but there is no question that in 16-17, China was reflating the global economy. Today, right now, they're a neutral player, but they could become more disinflationary as we go forward over the next 6 months. So what emerging markets need? Lots of liquidity, low volatility, and lots of reflation. And those 3 things might not be there 6 months down the track. So if we start looking longer term, I think EMs will still be under some pressure.
For a foreign investor into India, Victor, there is a peculiar problem as well, that if you've not invested in a country, but at least before 2 years, I mean, until 2016 or until mid-2017, global flows determine what India did. The last 12 to 18 odd months, because of the big shift of domestic flows into the Indian markets, while flows may have been missing or would have been a trickle really compared to, say, what some of the other countries would have enjoyed, say, for example, China has enjoyed, the markets are perched at highs. Does it make the job of a foreign investor that much more difficult? He's missed out on India thus far in a big way, but he can't get into India because the valuations are too demanding.
Yeah, that's a problem, but that's also a plus. In other words, one of the things India has is a lot of trapped liquidity within the country. So if you think of your bond markets, for example, how much is foreign? 5%, 6%. So in a sense, if you're investing in Malaysia, foreigners own as much as 40% of the bonds. If you go to Indonesia, it's very similar numbers. So one of the advantages of India, a lot of trapped liquidity. That makes you a little bit less volatile than otherwise would be the case. The real problem you have is that India as a country consumes too much and invests too little. And so the result is you end up with a transfer payments, which is reflected in fiscal deficits. And whenever you try to invest in underlying infrastructure, you start running current account deficits. So for the country as a whole, you're exposed. But in terms of different investment styles, as you correctly said, one of the great things about India, a lot of trapped liquidity. So you're much less subject to the same volatility as other emerging markets are that are far more dependent on net flow. Now, the side effect of that, of course, is that the good companies in India are very expensive. And so investors have a challenge. They like some of the companies, and there is a lot more in India than in any other country apart from China. Only China has a wider range. And there's a lot of interesting companies, good companies. There is a lot of domestic exposure they would like to have, but it is pricey. And so you're absolutely right. That's what's holding it back. You have domestic liquidity driving it, but a foreign participation is less than it should be. In fact, the last 3 to 4 months saw net outflows out of India from foreigners.
Okay, that's some global perspective coming with regard to Indian market.